If you remember, coming into 2025, I was already the cloud, dark cloud with the thunder, saying it's not going to happen again this year. Markets are going to struggle, and here we are, another robust year.
All right, joining me will be Brittany Christensen, Head of Business Development at Tidal Financial Group, who's a full service white label ETF platform that currently manages over 350 ETFs in partnership with some 90 plus ETF issuers. We're talking about over $50 billion in assets overall. And look, I know I'm always a broken record on this, but anytime I visit with someone like Brittany, who's at a white label issuer, I always say they have a front row seat to everything occurring in the industry because they're talking with new ETF issuers, they're having conversations with existing ETF issuers. I just feel like they get to see where the opportunities exist in the ETF market. They also get to see where the pain points are, right? So it's just such a unique perch in the industry. And I'm looking forward to this. We are going to walk through some of the big ETF stories Brittany is watching heading into 2026. I think we have 4 or 5 of these to go through. So, again, this should be a really nice preview of the year ahead in ETFs with somebody who does have that front row seat. Now, to start this week, I'll be joined by Cynthia Murphy, investment strategist at Vetify, and we'll also be previewing the year ahead. However, we're going to be doing it through a somewhat different lens because Cynthia has provided me with Vetify's latest advisor survey data, which focuses on how advisors are viewing the financial markets as the calendar turns to the new year. And longtime listeners know I absolutely love this stuff. I always say this provides such a great window into how advisors are thinking right now, which has implications for ETFs as well, right? This could impact ETF flows and launches and all of the other industry metrics that we follow so closely. So Cynthia and I will dive into that momentarily. As always, questions or comments, you can find me on X at Nate Geraci, or you can go to etfprime.com. Okay, let me now bring in Vetify Cynthia Murphy. Cynthia, is your holiday shopping done yet, or are you like a procrastinator?
Definitely procrastinator, but I'm already on just finalizing the wrapping stage. So now I got to get into my cooking mindset. What am I actually going to serve Christmas Eve and Christmas Day? So I have some catching up to do on other things.
All right, so you're pretty well organized, which doesn't surprise me. That's you. So I would say I'm in the same boat. So I'm feeling good heading into the remainder of the week. Okay, so like I said, this should be a lot of fun. We're going to look at this recent Vetify survey data on how advisors are viewing the financial markets heading into 2026. And I thought what I'll do is I'll just tee up each question and the survey results, and then we can bat these around a little bit and also talk potential ETF impact as well. Before we do that, though, do you want to explain where this data comes from, just to offer a little context here?
Absolutely. So we, as you know, at Verify, we do a lot of webcasting, collect a lot of behavioral data. So we're constantly assessing what the advisor landscape's doing. In every webcast we do, for example, we do an exit survey. And so we're asking all sorts of market questions, we do polling questions. And so we're constantly gathering data. So for today's episode, I looked at some of the latest insights we've gotten from advisors since about mid-November. So it's kind of basically just over a month worth of, how they're feeling about things, markets as we go into the new year. It's a little bit of a glimpse into the mindset of the advisors that we've been talking to.
Yeah, I love this data, and the data that you provided me. This is a real cross section. We have everything from survey data on equities to fixed income, crypto, which I'm going to bring up those survey questions for sure. But let's just get into the first survey question that we have, which very simply is in 2026, the S&P 500 will be, and there were 3 answers, either 10% or more higher, 10% or more lower, and then range bound. And 63% said 10% or more higher. 23% said the market would be range bound, the S&P 500 would be range bound, and then 14% said 10% or more lower. And I've got to tell you, that's surprisingly bullish to me. I'm an optimistic investor, but the majority of advisors thinking that we're going to get another 10% plus year after the S&P 500 was up, what, 26% in 2023, 25% in 2024. Last I checked, it's up 18% this year. That seems a little ambitious. So does that surprise you at all? I mean, the party has to end at some point, right?
I mean, maybe the only explanation we have here is recency bias. If you remember, coming into 2025, I was already the cloud, dark cloud with the thunder, saying it's not going to happen again this year. Markets are going to struggle, and here we are, another robust year. So maybe the story really is that the market keeps defying our expectations for a toning down of activity, so let's just keep betting on it and expecting for more. But to agree with you, I was surprised to how bullish we continue. But I kind of blame the market. It doesn't disappoint. So why not be a believer?
Can you imagine if we have, say, another 20% up year next year after what we've had the last 3 years? It's unbelievable. In terms of potential ETF implications, and I actually asked Morningstar's Ben Johnson this question last week, but how important do you think market performance is to ETF flows now? Because as you're well aware, we just posted back-to-back trillion-dollar years in inflows. I think we would both agree. I don't want to speak for you, but I think I can here that if we do get another, say, 10% plus year from the S&P 500 next year, I would certainly expect another trillion-dollar year of inflows. But what if we don't? Like, how much do you think that matters to ETF flows?
I actually don't think it matters too much. If you think like when we came back to go back to the beginning of 2025, I didn't even think we were going to match last year's record, 24's asset record, because we were talking about a market uncertainty, everybody nervous and caution, therefore lower flows. People are just going to sit more in cash, and we keep seeing the reverse of that. I mean, to use crypto as an example, look at the year Bitcoin has had, and then look at the assets into Bitcoin ETFs. So it's almost like anytime we think people are not going to put money to work in ETFs because their markets aren't delivering or people are nervous, the market goes, hold my beer, and I'm going to show you just how nimble you can be, just how tactical you can be, and move money around as markets challenge you. So it's almost like ETFs are really built for the challenge, and we keep seeing the flows come no matter the market environment.
Yeah, and when you look at where those flows are going, this has been well documented, but it is in a lot of the market cap weighted US centric ETFs, the VOOs of the world, and SPYM, QQQ, QQQM, VTI. So it's like if you combine that advisor question that we just walked through, that clearly advisors are still bullish on the S&P 500 with just what we're talking about with ETF flows. I mean, you just wonder what stops this train into the largest market cap weighted ETF. So certainly a story to watch next year. Let me get to the next survey question, which will jump over. This can impact obviously all asset classes, but this will get us down the fixed income path. The question is, where do you see interest rates by the end of 2026? 75% said lower, 7% said higher, and then I'm assuming the remainder said no change. I didn't see that in the data, but I'm assuming that the rest was no change. And I was looking at the Fed fund futures right now. Obviously, those are indicating additional rate cuts next year as well. So I don't think this is any big surprise. I guess I'll just ask you, like, what do you think could be some potential ETF implications here if rates do in fact move lower?
Yeah, I agree with you. No surprise there. I think most people we've been talking to are looking for at least two rate cuts next year. The big question seems to be the inflation component. If we do get inflation, could that actually then cause the curve to go lower on the short end and then higher on the long end because of that concern about inflation? And so what happens to that fixed income exposure? So this year, as you know from the flows, things like the ultra short term, like your SGOVs, Bill, those types of tickers, huge money gatherers this year. From all you look around all the outlooks, Vanguard, BlackRock, Wisdom Tree, PIMCO, going into 2026, this possibility of the split between the low end and the long dated end has everybody talking about the belly of the curve as the sweet spot. And by belly, we're talking 3 to 7 years roughly. And if you look at flows, actually, IEF, which is a 7 to 10, started picking up, a lot of assets there. But so just this concept of, pick up a little bit more yield on that short to avoid that drop in the short end, but do not take that duration risk because it could get dicey for long dated bonds. Now, if you look at flows so far this year, things like BND, AG, your core aggregate bond portfolios have picked up some assets, but that effective maturity and the duration on those funds is under 6 years right now. So it's kind of sitting in that, belly of the curve space as well. So I think we could see like words like barbell or fixed income exposure. I've heard that so many times in the last couple of weeks, and just really focus in that middle. Or if you're really concerned about inflation on the long end, maybe reconsider tips and hedge some of that inflation risk. So I think we're going to see some repositioning, and possibly could we actually see some money come out of money market funds as they try to lock in some of these higher yields before rates start to significantly drop. We could see some action there as well. It will be interesting to watch.
Yeah, I absolutely love your point regarding, what if short-term rates come down as expected, but perhaps longer-term rates tick up because of, to your point, lingering inflation concerns, and I would say the growing government debt, the fiscal situation. And my sense is that just in talking to a lot of advisors and investors, they're still very hesitant to take on much duration risk. And quite frankly, I'm not sure that I blame them. I think I'm in that same camp. So I think that's a really interesting point, and I think you're right. Sort of the belly of the curve there. Your even like your IEIs. What is that? 3 to 7 year treasuries. I think those could see some significant flows. The other point that I'll make, which I love that you highlighted, and I've talked a lot about this over the past few months, is just the assets and money market funds. And last I checked, it was something like $7.6 trillion in there. And so if rates come down, which they already have, at some point, I would think that advisors and investors go, you know what, can I get a better yield elsewhere? And I think that could then lead to a pretty interesting year for fixed income ETFs overall. I'm actually going to talk about this in the next segment with titles Brittany Christensen, just regarding innovation around fixed income ETFs if we do continue to have rates decline. So I think both of those are again really good points on your side. The next survey question that you provided here, I thought this one was really interesting. It's what concerns your clients the most. And by the way, I'm doing some rounding here on the answers. So if you're really good at math and realize that these don't add up to 100%, that's why. Don't like write into the show or ping me on X. So again, what concerns your clients the most? Number one, market volatility with 48% of respondents. Number two, uncertain U.S. policy. That was 32%. Three was market concentration, 13%. And then changing interest rates, which obviously we were just discussing, 4%. Any big takeaways on this one? I mean, clearly volatility and uncertainty, that's something that we're always talking about with clients. I think that's always a concern. But market concentration, that's interesting that not much of a concern among surveyed advisors here.
Yeah, maybe we've grown accustomed to, leaders will be leaders, at least for the time being. And so there's no point in keep talking about diversify from what big tech or AI driven names. I know, like, I've heard Eric Balchunas many times mention that you actually in the Mag 7, you own something like 800 different companies because they acquire so many smaller players. So you actually really diversified in 7 names. So maybe we're believing that more and more, or the concept is sticking. And I was very surprised because one of the ballasts of good long-term investing is diversification. So concentration can bring so much risk to your portfolio, and yet it ranked so low with advisors as what's driving their key concerns, what they're talking to clients most about. So I thought that was interesting. And on the flip side is recurring theme like uncertain U.S. policy. 2025, the year of uncertainty, that apparently will continue. I'm sure you remember on the latest earnings round, a lot of the forward guidance still trying to detail, the expected impact of tariffs next year. So we still haven't really seen what that has done. So there's a lot of uncertainties, and that's driving concerns, and that should lead to market volatility, which is a concern. So maybe concentration can wait for now, I guess is the takeaway.
But you know what's interesting is that the lack of concern from advisors here around market concentration, obviously that comports to what we're seeing in ETF flows, which I was talking about earlier. I mean, we're seeing billions and billions of dollars continue to flow into market cap weighted products that are very top heavy. And so clearly there's just not a concern here yet. My take, and I know again we've talked about this over the past several months as well, is just that I think we have to see a prolonged down move, something that people really believe is real and lasting to get them out of market cap weighted U.S. stocks. And even then, I don't know that you're going to fully get them out, right? The Vanguard type investor is just going to continue to buy uh, no matter what. So I thought that was interesting. The other thing that I took away from this, the result of this question, just with the concern around market volatility and uncertain U.S. policy, those sorts of things, is just that I think this points towards further momentum behind defined outcome ETFs and other structured outcome ETFs. I assume you would agree with that.
Yeah, I mean, so defined outcome ETFs to me are interesting because we talk a lot about them, and they've had a record year of asset gathering. I think the is 12, $13 billion, which is a lot of money, but in the context of $1.4 trillion in flows, is not a ton of money. Uh, so I think adoption has been strong and growing, but it just tells me that folks are still not wanting to give up that upside potential. They're still believing in the potential rally, to talk about the double digits gains in S&P 500 for another year. And with the defined outcome, you do have a capped upside. And so I think, to your point, when things do turn sour, absolutely. I think for now, flows haven't been bigger than they have been, potentially because nobody wants to leave any money on the table if they don't feel like they have to yet.
So maybe Goldman Sachs purchasing Innovator for $2 billion, that's going to look like a really good deal if we do get a lot of market volatility and continued uncertainty. We'll see how that plays out. All right, next question. And it's funny, I'm sensing a theme here. You'll see what I'm saying as I go through these results. But the question is, which investment style or asset class do you expect to initiate a position in or add to within 2026? Number one answer, large cap US, 30% of respondents. Number two, small cap US, 21%. And actually, that was tied with international equities, also at 21%. And then other was 9%, fixed income was 7%, and then 12% of people said none. But the three big ones here: large cap US, small cap US, international equities. And, once again, I'm a little surprised that large cap US is number one, which we keep talking about this. I feel like we're beating a dead horse this segment. But on the other hand, if it's not broke, don't fix it. And I think that's how a lot of advisors are thinking right now. They're still going to continue to favor US large caps until something changes. So, what did you think about those results?
Yeah, I think if we think about the advisor position where they have to sit in front of a client and explain why they made that decision, to your point, if it's not broken, at what point do you just decide I am not going to keep betting on US large cap because I expect some correction down the line, but you're leaving all these returns on the table. So it's a tough spot to be in. To change the bet from the winning horse on the expectation that the winning horse is going to trip on the next race. So I get that. I actually think the other side, the small cap and the international, is really interesting because it's a pretty high percentage. And as you know, we came into this year, and you especially, Nate, were super skeptic on the international equity calls. And here we had a year where, you name it, the market is done really well. Developed, Europe, emerging markets, Japan, they're all up, like China, up over 30% this year. And so now we're seeing folks actually like, okay, this wasn't just a quick, drive by. It's sticking. So we see that interest in expanding to positions in next year. And in the small cap space, I mean, find one big asset manager outlook for 2026 that doesn't call for small caps to finally come back, especially in the context of lower rates. They already started performing well late into this year, and everyone is looking for small caps to shine. I actually just recently talked to the Wisdom Tree guys, and I asked the final question in their conversation with them was like, okay, so small caps next year, bridesmaid or bride? And they didn't skip a beat, bride. So I think it could be the year where we finally see small caps also deliver, and we see this broadening out of this rally we've been expecting. So I think the interest in adding positions in those segments is very reassuring.
All right, you offered a lot there on small caps. I'll just say certainly those could outperform, but I know this is another topic you and I've talked a lot about, just that so many companies are staying private longer. And it's not like the traditional small caps of say 20, 25 years ago in terms of the exposure. It just feels a lot different now. So that's going to be one where it has to prove it to me. And I like that you called me out on being somewhat, would you say, skeptical on international coming into the year. I'll tell you what, I do think that international equity ETFs could be a huge story in 2026 because if they do sustain their outperformance, obviously that's going to bode well for international equity ETF flows. And you look at performance this year, I mean, both developed and emerging markets, they're broadly up. Like if you look at a IEFA or IEMG, they're up about 31, 32% versus 18% on the S&P 500. So to exactly what you're saying, this wasn't a flash in the pan. It wasn't a few months of outperformance. It was sustained throughout the year. And I'll tell you as an advisor, it's funny. I had a back and forth with somebody on X over the weekend, just talking on this topic of international ETFs, and they were saying, you know, if you were underweight international this year, you underperformed, right? Sort of a global market weight portfolio. My response was yes, but what have you done the past 15 years? Because if you were overweight international, you probably don't have any clients left. If you're an advisor. So I just think it's going to be real interesting because you bring up a good point in terms of sort of that career risk that if international continues to run, advisors have to be aware of that. And even though they've been snake bitten over the past, again, 10 to 15 years, they may have to change their tune on that. So again, I think another big story to watch. Go ahead.
So yeah, I just wanted to add 2 points to that. So on small caps, I think the point is to your point, the staying private longer, the unprofitability. We all talk about the Russell 2 having what 35-40% of the names in that index be unprofitable. So I think it's a space where you're going to have to be pick and choosy about what you own. And active managers have done a great job. If you look at some of the Avantis funds, for example, I think their small cap fund is up 36-37% this year. So just be smart about that exposure. Don't just load up on small cap because of the size factor. Actually look for that profitability component. I think that would be key. And on international, I think it could be an interesting year for, as we broaden out the theme, to maybe look at some country specific, not to keep harping on the Wisdom Tree guys, but they had a chart of the week recently, chart of the day recently, that showed that China and India, for example, the two of the biggest emerging markets, are actually for the first time ever negatively correlated. So you have the China equity market up over 30% this year, and you have the India market up 1%. And it's a complete opposing story. One is a big value play, one is a richly valued growth is faltering play, and they're moving in completely different directions. So it could be an interesting year to really be strategic about your exposure in international.
That's a great point. I mean, on one hand, to me, that paints the case for taking an index based approach to international. But on the other hand, if international does maintain this outperformance or does sustain this outperformance, as you know, there are going to be individual countries or regions that really run. And so there could be a pretty significant opportunity there. So that's a good point. I think we'll have to watch the country specific ETFs next year. So I like that. Okay, just a few minutes left here. Let's close with what else? Crypto. So I have two survey questions here that you offered up. The first is simply what percentage of your clients currently holds cryptocurrency or other digital assets? So there's a lot of percentages here. I'll try to summarize this. So 53% of respondents said they hold 0% in crypto. 38% said they hold between 1 and 10%. 6% said they hold between 11 and 25%. And then there were 3% that said more than 25%. And just looking at this, Cynthia, my takeaway was I'm actually surprised at how high the percentage is for clients that hold crypto. I would have expected something much less. That's a big number. I mean, nearly what, half uh, holding crypto exposure. So, any thoughts on that?
Yeah, I actually think it's a high number that don't yet. Like 50% don't. About 40% do. But I also think it's a space that so I don't know. I have mixed feelings about the numbers. I think it is what it is. I also think it's, what crypto, they're probably just holding Bitcoin. If you look at the flows, it's IBIT, or now, ether is picking up some assets as well. So I am looking to see the expansion of this theme and what that does to these numbers as well. It just tells you that I think we have a long way to go in this category, which is also not news to anybody, as we know. But like talking to my colleague recently here, Roxana, who you know well, Nate, she was looking at some of the research she's done this year, and her single most read article this year was about Solana. So, which is also kind of fascinating. So I think it's very exciting to see this advisor adoption of crypto expanding, the doubts that persist on that 50%, the enthusiasm on that 6% that already own 25% more in crypto. I think the whole segment is really exciting.
Well, speaking of the fact that maybe we have a long way to go with crypto and crypto education, the other question that we have here is just why crypto? Like, what is the primary reason clients ask about crypto? This is fascinating. So, 50% of respondents said speculative growth opportunity, which that's fine. I don't know if I can argue with that. 28% said diversification. Okay, that makes sense. 22% said FOMO, fear of missing out. But listen to this, 0%, 0% said conviction in underlying technology. That hurts. 0% with conviction in the underlying technology. They must think it's like vaporware or something. But yet, nearly half of clients have crypto exposure. So help me understand this one.
Yeah, I think it just draws a very clear line between industry talk and actual real world application. So we sit here, and by we I mean the super smart crypto people, which I'm not one of them. But talking about the tokenization and banks going on the chain and what the future looks like. But in the real world, when you're sitting there with a client and say, should I put money into this? It's still, the conversation is about, it's a growth asset, it's a risk growth asset, and it plays well also in the debasement of the currency story. It plays well also in that let's diversify risk within your risk assets category. That whole like technology frontier, I think we haven't gotten there yet in that conversation level. And I can't blame anybody either, because as you know, the technology conversations move so fast. If you're an advisor with so much that's going on, how do you keep up with that? It's crazy. I don't know how you do it. So I think it's totally understandable.
Which is why this isn't going to surprise you. I'm so bullish on crypto index ETFs because I think you're right. I think a lot of advisors, they don't want to be digging into the underlying technology. They feel like there is definitely something here. They see value to diversifying. They see value to the growth of this technology, but they don't know exactly how to play it. And so I think they're going to look to crypto index ETFs. I'm very bullish on those heading into 2026. But Cynthia, fun chat as always. Always love hearing your insights. Thank you for joining me.
Thank you, Nate, for having me. And thanks for a wonderful 2025 year of podcasts. So I'll see you next year.
Well, thank you. I look forward to it to 2026. That was Cynthia Murphy, investment strategist at VettaFi.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
Looking for ETF options from one of the top asset managers in the industry? Visit i.fidelity.com/ETFs to explore Fidelity's lineup and more. Fidelity Distributors Company, LLC, 500 Salem Street, Smithfield, Rhode Island, 02917. Fidelity Investments is an independent company unaffiliated with Verify and other third parties on this podcast. There's no form of legal partnership, agency affiliation, or similar relationship between Verify, Fidelity Investments, and other third parties on this podcast, nor is such a relationship created or implied by the information herein. Fidelity Investments and/or Fidelity refers collectively to FMR LLC, a U.S. company, and its subsidiaries, including but not limited to Fidelity Management and Research Company LLC, FMR. When it comes to active fixed income, AllianceBernstein leads the way. With AB's systematic fixed income ETFs, the AB Core Plus Bond ETF ticker CPLS, and the AB Corporate Bond ETF ticker EYEG, advisors gain access to Core Plus and investment-grade bond exposure backed by cutting-edge proprietary technology. These ETFs combine deep research with risk-aware strategies to help you navigate today's markets confidently. If you're ready to enhance your bond allocations with solutions built for the future, explore CPLS and EYEG from AB. Visit abfunds.com/go/ETFS to learn more. Investing in securities involves risk and there is no guarantee of principal. Investors should consider the investment objectives, risks, charges, and expenses of the fund/portfolio carefully before investing. For copies of our prospectus or summary prospectus, which contain this and other information, visit us online at www.alliancebernstein.com or contact your AB representative. Please read the prospectus and/or summary prospectus carefully before investing. CPLS and EYEG, distributed by Foresight Fund Services, LLC. Foresight is not affiliated with AB.
I'm now joined by Brittany Christensen, Head of Business Development at Tidal Financial Group, who's a full-service ETF platform managing over 350 ETFs in partnership with 90-plus issuers. So they're now over $50 billion in total assets under management overall. And very simply, Tidal can help a firm launch an ETF. They can help them manage an ETF, certainly grow and market an ETF. They can convert managed accounts or mutual funds into ETFs. They can really do it all. And as I mentioned at the top, I think because of that, Tidal and certainly Brittany herself, they have a front row seat to everything occurring in the world of ETFs. And Brittany is now joining me in that front row seat from Salt Lake City. Brittany, it is an absolute pleasure to connect. Welcome to the podcast.
Thanks, Nate. Thanks for having me.
Okay, so did I describe Tidal correctly there? I like to think of you as a one-stop shop for pretty much any ETF need, but at a very basic level, if someone has a great ETF idea, they can come to you and you make that idea a reality, right? You bring it to fruition. So is that how you like to describe what Tidal does?
Yes, it's exactly right. We built everything so that you had a one-stop shop. All you need to do is bring your investment idea and you want to be the face of a new ETF business. So we built everything to be able to support everything else that you need in the back end. And then I'd say my journey since joining Tidal roughly 3 years ago has been about sort of breaking down our full out-of-the-box solution and offering it also in sort of modular form or a la carte format so that larger managers who already have some parts of the ecosystem or the infrastructure to support their business don't necessarily need everything that we have on the menu.
So just explain that in a little bit more detail. What does that mean? What does that look like exactly?
Absolutely. So, as we're seeing, I guess, larger and larger asset managers come into the US ETF space, some of them already have existing 40 Act product, right? And so I think we're going to get into some of that topic in a little bit of detail during this conversation. But if you already have an existing 40 Act trust and you've already got trustees and parts of your business are already stood up in that kind of regulatory environment, the ETF isn't that big of a leap for you, but you might still have certain gaps around, let's call it trading and capital markets as an example, right? And so you can hire a specialty team like Tidal, who manages the trading capital markets for not only all of the ETFs that we launch on our series trusts, but also work with a number of outside trusts as well to just support them as sub-advisor in the ETF space.
Yeah, so really if somebody has any sort of gap, I would say Tidal can fill that when you think about product development and then just the entire life cycle of an ETF. Again, everything from inception to capital markets, marketing, you can do it all. So, okay. I mentioned your front row seat in the ETF industry. And so I thought because of that, it might be fun to cover some of the big ETF stories on your radar as we head into 2026. And you were kind enough to provide me with 4 or 5 of these stories beforehand. And so, what I'm going to do, Brittany, I'm just going to tee each of these up. You can tell me what you're thinking, and we'll just see where that takes us, if that works okay for you.
That works great.
Okay, so the first one I would say is a big one, and it's a story that's already getting a lot of attention, and that's the multi-share class structure. And as I know you're well aware, last week the SEC indicated that it's set to approve this structure for a boatload of fund companies. So this includes BlackRock, State Street, Fidelity, Schwab, JP Morgan, PIMCO, Morgan Stanley. I could keep going, but we're talking about some of the biggest names in asset management. I think it was nearly 36 asset managers overall. And of course, that follows the SEC approving the multi-share class structure for Dimensional back in November. I would say Dimensional sort of set the blueprint here, so to speak. But to start, I'll just simply ask you, how big of a deal do you think this is? Because I feel like there's at least some debate in the industry around how impactful this might be. I think everybody thinks that it's important, but there's clearly a spectrum here. Some people think it's going to be a huge deal, some maybe not so much. So what's your broad take here?
Great question, Nate. And I think one of the interesting things as I'm researching or preparing to answer this question is you look at two of the major rule changes that have happened in the last, let's call it short history, a 30-year history of the ETF space, right? A lot of them happened in 2019 around 6C11. And we kind of saw two major things. One, a lower barrier to entry for active managers coming in. And then you had sort of the semi and non-transparent solution that was rolled out alongside it. Now, what you saw is that the ETF rule, as it's commonly called, was the panacea moment. But what we didn't need was the tool that came along with that change and that regulatory hurdle being removed. What I think you're seeing with share class is probably somewhere in the middle. I don't think it's as big as the ETF rule. I don't think it's as unadoptable as the semi-transparent, but there are things that sort of lend to both categories, if you will. So there's elements of the share class that lower a barrier to entry, right? If you're an existing mutual fund shop, you're probably sitting there thinking, I got to get in this ETF game. I can't stop hearing about it. I really need to figure out my entry point. And this might be a really natural fit for a lot of those managers. Not everyone, and we'll get into maybe some of the nuance in a second, but the other bucket is, the semi-transparent wrapper, the non-transparent wrappers didn't get broad industry adoption because they failed to acknowledge some of the mechanics in the ecosystem that were required in order to support an effective ETF product. And I think you're going to find some of that with share class also. So it set out to solve a lot of big problems, ETFs and mutual funds, sister products in the 40 Act, but there's obviously one that has a much better tax efficiency mechanism to it. So I think when you look at this, it will be a big genesis of growth. I think it will actually force mutual fund managers to come back to the drawing board of the decisions, though, and still effectively evaluate, do I do a share class, do I do a clone, or do I start with new product lineup? So I think that's still very much going to be the path for most managers, is to strongly consider all three options. And it might not be that the same solution fits your entire suite of mutual funds.
We'll talk more about that drawing board or that evaluation process. I'm curious what you think are some of the biggest considerations around whether to offer an ETF share class of existing mutual funds, or vice versa, right? There are some firms that are seeking to do the opposite, which we can talk about that later. But let's start with the former. What are the key considerations around offering ETF share classes?
I mean, I think a part of it is understanding your current investor base and does this serve them, right? I think that's got to be your first point of entry. Do you have investors who are in the fund that are looking for it in a tax efficient way? Is the fund mostly made up by retirement assets? Those are some of the questions that I think you start to understand and draw the picture of your investor base. Do you have a lot of direct shareholders? Do you have a lot of platform adoption? There's certain things in that sort of evaluation that you're going to start to say, maybe this is a better option for conversion, or maybe this is a better option for a clone. I think if you're looking for something that needs share class, you're going to want to find something with no load fees, or maybe it's a newer, not fully adopted on the platforms yet, or you're going to have a fee normalization, right? And so I think funds where you're looking at a lot of different share classes, and now you're adding the last one, the ETF, that's probably a little trickier to manage than if you just have one flagship mutual fund class and then you bring the ETF class as its tax efficient sister, right? So I think there's just a lot of decisions that go into it. Unfortunately, I guess my advice to any mutual fund shop manager is to don't try to make the decision uniformly and to try to talk to someone in the ecosystem who will help look at individual fund factors that you should be considering as you're approaching the decision.
So reading between the lines there with what you just said, it doesn't sound like you're expecting, say, mutual fund to ETF conversions to go away or clone strategies to go away. It's really, there's this decision point between conversions, clones, and then ETF share classes as to what a manager does. They have to evaluate find out what's best for them. I mean, is that effectively what you're saying?
Absolutely. Absolutely. I mean, I think in many cases, you might just find it a path of least resistance to convert some of your smaller or newer funds, right? Then you don't live with some of this issue that most of the industry, I think, is now effectively talking about, the 12B1 fee consideration and how we think about distribution in the mutual fund versus an ETF. It's quite different. So if I had a large fund, my biggest flagship fund, and it's onboarded to all the major wires, I'm probably waiting and seeing how share class plays out. But if I have one that I started a couple years ago, it's got 50 million in it, that's probably a good place to start converting and at least get your name to be known and your brand to start resonating with the ETF investor audience while you're sort of, let's call it, following in the footsteps of some of the industry innovators who are really pushing the needle on how this will work.
It's interesting you mentioned the 12B1 fees. I actually saw a stat this morning. It was from Cerulli, where basically what they said is if there were really high rates of conversion to ETF share classes, they said that could put up to $30 billion of annual 12B1 or sub-TA revenue at risk for the broker-dealer industry. That's a huge number. And I wonder, if we'll see some of those fees try to come in the back door on the ETF side. Do you have any thoughts on that, just what the fee structure may look like?
Yeah, I mean, I think it forces a conversation that's needed to happen for many, many years, to be honest. I mean, there's a lot of ETF issuers who don't understand sort of the landscape of how the fee structure worked in the legacy world of mutual funds, right? And how distribution kind of was working. One of the things that ETF issuers struggle with is data. What do the platforms have access to be able to produce for ETF issuers? It's data. So I think if we can find a conversation that lends to helpful outcomes, I think that you're going to see that maybe the fee differences between mutual funds and ETFs will start to coalesce over time. But I don't think that that's a quick thing that will happen. And I also don't think that that's going to be a sweeping regulatory change. I think you're going to start to see some of the larger issuers pioneer, or some of the larger wirehouses pioneer how they're going to solve for that gap. Everybody sees it coming at this point. I mean, I think part of the biggest roadblocks for any mutual fund manager looking at the ETF space is how do I do this without making an enemy out of the distributors that I've been using to get to this point, right? Nobody wants to enter a business by sort of cutting off the part that got them to where they're at as a successful mutual fund shop. So there's just a lot of care in that. And relationships matter there too, right? A lot of these, let's call it advisor community, wants access to this IP because they have some clients who only want to hold ETFs. They have some clients who are very comfortable in mutual funds. So I think it's about recognizing where we have overlapping incentive structures and then figuring out where the incentive structures need to, let's maybe just say, evolve to where the ecosystem is now. Clearly, ETFs aren't going away.
Well, and you know better than anybody, and this is entirely cliche, but distribution is king in ETFs and really the asset management industry overall. And so that distribution puzzle, that has to be solved for any asset manager. The other thing that I would say, and we can move into some other topics, is just that if you have an underperforming mutual fund, the ETF wrapper isn't going to magically fix that, right? It may help in terms of lower costs and greater tax efficiency, and that certainly can help overall performance, but it's not going to magically fix bad stock or bond picking or a bad quant process or whatever. So I think that's important. One other real quick question on this topic, I mentioned that there are a handful of issuers that are seeking to offer mutual fund share classes of existing ETFs. And so somebody like FM Investments is one that comes to mind for me here. But do you have any big thoughts around that and maybe what type of opportunity that could present for ETF issuers?
Yes. So I think actually, maybe unpopular opinion here, but I do not think that every mutual fund belongs in an ETF wrapper. I think that there's limitations to certain strategies that should go into the ETF. However, I do think that every ETF could be in a mutual fund wrapper. And so I think that there is a lot more opportunity on that side. I also think that regulatory and operationally, that opens up a whole new group of assets to the ETF issuer community that we haven't really been able to access before, sort of the 401k part of it, of the allocator space. So I think you'll see that there will be more opportunity that way. I also think there's less friction because you're not going from a multi-class to adding a different class. You're kind of starting with the ETF class and just adding one clean mutual fund class with a very specific intended purpose, which is to bring the investment products to a bigger audience of non-taxable investors. So I see a bigger opportunity like FMCs that you'll see more ETF issuers launching the mutual fund share class once we start to see that adoption coming from the 401k plans. And Title has actually, we're in the ring, right? We're in the filing lineup with everybody for that exact purpose.
Well, and very simply, I would just add that I think we would both agree that most of the innovation occurring in asset management is occurring within ETFs. And so what this would allow is that innovation to come into the mutual fund wrapper, which, I'm painting with a broad brush here, hasn't necessarily been quite as innovative. So I think that's the real benefit. If we move away from the multi-share class structure story, another big ETF story on your radar for 2026, this is one I love, 351 conversions or exchanges. And it's funny. So I had Morningstar's Ben Johnson on the podcast last week, and you'll like this. I asked him who would be his best new ETF issuer of 2025. You know what he said? He said advisors, because he was referring to advisors who were taking advantage of 351 exchanges. I thought that was pretty good. I like that. But talk more about what Title is seeing here and why you are bullish on 351 exchanges.
Absolutely. So you called it right at the beginning of the year. They're going mainstream. They are mainstream now. I don't think I can get through a single day without talking about 351.
Thank you for bringing up my correct prediction, by the way. I like that.
Yeah. Check mark for you on that one. It was definitely I'd say the biggest theme of the year. And I would say probably a bigger opportunity in many cases than the share class, because there's so many things to figure out with share class. Whereas 351 has been around for a long time. You're sort of marrying two different, let's call it regulatory structures with the IRS code and the 40 Act and how we're thinking about bringing them together. I think there's still a lot to learn about 351, but it solves the age-old problem for an ETF issuer, which is I don't have any seed. I need the chicken before the egg and the egg before the chicken type of conundrum. So if you can find someone who's got similar overlapping positions to the strategy you're trying to bring to market, that's a win-win for everyone. I think there's a lot of people out there that are looking at 351s as sort of this tax magic wand. And I think in the right set of example or scenarios, it is. But I think if you speak to any tax attorney on the topic, they're typically going to tell you that business purpose is very important to any interpretation of the tax code. And so I think that where we like to start with someone is, it's not, hey, I've got all these assets and I'm looking to get rid of I'm looking to defer my taxes and increase my diversification. I want to start with, why do you want to be an ETF manager? What are you trying to do with the ETF business? Because, a lot of us in the ecosystem see the growth and we see a lot of products coming to market. But there is this reality of, if you bring something with a bunch of assets and you don't have any intention to grow it beyond that, there are other parts of the ecosystem that start to break down. Investor hygiene, how many large cap growth stocks, ETF options do we need to choose from, right? So I think that there's this element here of being selective on a 351, finding that right set of circumstances. That's kind of been our approach. The right set of circumstances that's a win-win for everyone and gives us a lot of confidence that going into the next 3, 4, 5 years of audit history of the fund itself, that we're going to be able to continue to justify the business purpose of how we've been trading the portfolio.
That's a really interesting point. So if I could restate that, what you're saying is, obviously you have the tax deferral opportunity with the 351 exchanges. You can diversify your portfolio if you had a more concentrated portfolio of stocks, right? You do the 351 exchange. But it sounds like what you're saying is, yes, those are great. But if you're going to do this, there should also be some desire to actually grow the ETF and distribute the ETF. Do I have that right? That this shouldn't just be sort of a one-off exchange, that there should be broader goals here?
I generally think so, and that's how we've been thinking about it here at Title. I think there's a lot of great use cases. If I'm running a bunch of SMAs, I'm looking for efficiency, operational efficiency. I might be a relatively successful independent RIA, got relatively similar holdings in my core equity strategy. I manage it the same now. I think it's got good returns. I'd like to put it in an ETF. And by the way, I can do this, bring seed, and have a bunch of tax good outcomes for my clients. That's a perfect scenario. Lots of business case justification, lots of reasons for everybody involved to do it. When you start to see this break down is when there's just too much in here where it's very clear a lot of my motivation is to do this for tax. So I end up with conversations like, okay, what if I did 4 and in each of them we brought 20% of my NVIDIA and then we merged them all together at the end, right? So that's getting a little creative, I think. And that's where I think there's still some risk that we haven't seen play out in the broader ecosystem yet. But I think as these become more mainstream, there will be more attention on it from a regulatory perspective as well. So I think we should all be ready for that.
Well, and not just a regulatory perspective. Do you have any concerns that our friend Uncle Sam, the IRS, starts looking at these and perhaps has some heartburn? I know changing the tax code doesn't just happen overnight, so this isn't something that would just go away. But do you think that's a risk at all longer term?
I think that's why when you speak to a lot of us in the ecosystem, we'll give you our one pagers and we'll give you things. And there's a certain point in our conversation where we're going to say, we need to get tax attorneys involved. And we maybe want to bring in our fund auditors to the conversation. They're most up to date with what's happening real time on the back of audited funds that have already been through a 351 transaction. And so I think it's about making sure you've got your ear to the ground on what's most current about that, because it is rapidly evolving. And I think anything that gets a lot of airtime in the press and the media that is specifically coming after revenue for the IRS is probably something that will draw their attention at some point.
All right. 2 other ETF stories that you are tracking heading into next year. The first one, this is interesting, the ETF market moving more upstream. And you mentioned firms like Rockefeller, Transamerica, Voya, Pictet. These are firms who have already filed or launched ETFs through Title. And you said you expect this trend to continue in 2026. So give us some more color on that.
There was obviously first movers in the space, right? You got DFA Capital Group who came in, sort of started blazing the way. And I think you've got a lot of other managers who said, look, I'm not trying to be the first here. I want to sit back and kind of watch how things move. I think you're starting to feel that FOMO increase a little, right? I think people are like, I've been on the sideline. I've been waiting for share class. Know what that's looking like now. It's still not the silver bullet that I was hoping it will be, but at least it's an option and I know what it looks like. So I think you had a lot of people waiting for that decision to be made with those filings. And I think what you're seeing now is it's almost unavoidable that I need an ETF in order to future-proof my business. I think that people are starting to read a lot of the industry research around the investor base shifting, millennials being the biggest user group of ETFs. I think all of that is very much real momentum behind the ecosystem. I think what's actually been missing is that there hasn't been a ton of solutions out there for the larger asset managers, except for hiring talent. So I think increasingly as the ecosystem grows and evolves, one of the things that we did, like I mentioned at the top of the call, was sort of break down our offering into more a la carte bite-sized pieces. So if someone has a majority of what they already need and they just want someone, let's call it the bat phone to the ETF masters, that's sort of what we also offer, right? And that I think has gotten a lot of people very comfortable with making the leap, but knowing they have some trusted partners to bounce questions off of when they run into some issues, inevitably, which will happen sort of the first couple of months of the ETF.
The amazing thing to me is just, and you look over the past few years, you feel like, or I feel like in many regards, the ETF industry is mature. And then you see these monstrous names that are still coming to market. And you're like, we're still so early in where this is, maybe not too early, but we'll say, 4th or 5th inning. We're not 8th or 9th. So you can see that with the names. Okay, the other topic that you offered up as a story to watch next year was fixed income ETFs. And you noted how 2025 was obviously a huge year for this category, but you said as interest rates potentially move lower, you're expecting more issuers to file for products here. And so talk about some of the conversations that Title is having around this with issuers, and then perhaps how you see the fixed income ETF category continuing to evolve.
Equity makes a lot of sense for most people looking at the ETF space. It's tax that's the main draw. On the fixed income side, I think the liquidity is the draw, right? And so being able to access a portfolio of fixed income instruments, highly liquid, is something that we're seeing actually increased adoption from the institutional community. The institutional investor community, your pensions, your hedge funds, want access, but they want it more in a more liquid fashion. And so I think that's the genesis of the fixed income innovation that's coming. I think there's probably more opportunities, let's call it, for active management to really shine in the bond space versus the equity space. I think you've seen that play out in the mutual fund space over the last 100 years, that you're probably going to have a wider dispersion of active management who's really outperforming their benchmarks. What I think is also interesting, though, about fixed income ETFs, and I didn't predict this at the beginning of the year, I still believe that fixed income innovation will happen, but you're also seeing them compete with the equity income option strategies, which I think is a whole new, let's call it, use case in the advisor mix-up of growth and income. And I think you're seeing people maybe looking at those option income strategies as a potential replacement for some of the fixed income. Whether that ends up being the right play in the long run or not, I think that's still TBD, but an interesting rate environment, if nothing else, does allow for innovation in the fixed income market. And so I think having, different rate environment going into 26, ups and downs, will lead to better outcomes, portfolio managers being more creative and bringing it to market in the most liquid and fastest growing wrapper would make sense.
Yeah, I think that's really well said. I talked about this a little bit in the prior segment, but let's say we do have a shifting market environment where the S&P 500 isn't up 20% plus in a given year, and maybe we actually have a more sustained downturn. Clearly, that's going to have investors looking at fixed income ETFs. And then the other big wild card here is the $7.6 trillion in money market funds. That is, short-term rates have come down, and it looks like they'll continue to come down. Investors will be looking for solutions here. And obviously, they'll look over to the fixed income space. And by the way, going back on the equity side, you mentioned option income ETFs. Obviously, with those, depending upon how it's structured, you do have some downside risk, potentially substantial downside risk. So those are not the same as fixed income ETFs or traditional fixed income ETFs. So I think that's a good one. That'll definitely be one to watch. But Brittany, we'll have to leave it there. This was a lot of fun. Good stories to watch. We'll have to check in maybe like mid-year, and we'll see how all these are doing. But I like all of these. I think there's a lot of certainly a tailwind behind each of these. So again, we'll have to check in mid-year, but thank you for joining me.
Thanks, Nate. Nice to chat with you.
That was Brittany Christensen, Head of Business Development at Title Financial Group. That'll do it for this week's ETF Prime. I want to thank one of our sponsors, Whole Tactical. If you'd like to learn more about how the Whole Tactical US ETF can complement your S&P 500 exposure, visit wholetacticalfunds.com. No podcast next week, but I will be right back here the first week of 2026 to kick off another, hopefully, very entertaining and insightful year on the podcast. So hope you'll join me for that. Until then, enjoy the holidays, and I'll see you in the new year.
ETF Prime is hosted by Nate Geraci, president of OTR Media, LLC. Nate is also president of investment advisory firm Nova Diaz Wealth Management. While OTR Media and Nova Diaz are related by common ownership, they are separate and distinct entities, and anything discussed on this program should not be construed as an official statement by Nova Diaz. This program is for informational purposes only and does not constitute investment advice. Investing in ETFs involves risk, including possible loss of principal. Any past performance figures discussed are not necessarily indicative of future results. Some guests appearing on this program may also be financial sponsors of ETF Prime. OTR Media and Nova Diaz are not affiliated with VettaFi or any of its affiliates. VettaFi's participation in this program should not be construed as an endorsement or an indication by VettaFi of the value of any OTR Media or Nova Diaz product or service. Visit etfprime.com for more information.